This is a Silicon Valley real estate market update for the week ending May 1st, presented Saturday morning, May 2nd. These are the key chapters we're going over. If you want a PDF of the PowerPoint slides, hit the QR code in the bottom right corner. Here's the first data slide. Basically, what it's showing you is the market is basically normal. You have green and blue and red over here. I would say there's more green, which is normal. Red is favoring the seller. Blue is favoring the buyer. The only places that are really favoring the buyer are in Dublin, Livermore, Castro Valley, and Pleasanton, with a very long turnover time of 140 days roughly for both of those areas. The real takeaway, though, is coming over to the dark green grouped columns. Those are compared to normal. And what this is basically doing is showing you green and blue, which says that the market's the same as the 10-year median or favoring the buyer from the 10-year median. So even though we're still a fast-paced marketplace in Silicon Valley, it's a good opportunity for buyers to get in because there's less competition, more selection, and basically conditions are favoring the buyer more than they typically do. By favoring the buyer, you're 38% longer turnover time. It's taking longer than it typically does by 38%. But what does that mean? It means it's taking 43 days or just over 6 weeks. It's still fast-paced, but at 38% longer than the 10-year median, it's not a bad opportunity time to come in if a buyer doesn't want pressure. Also, favoring the buyer, 24% more inventory than there typically is at this time of the year. So out of every 4 homes, there's 1 extra home for you to see. Offers, there's less offers, so the sellers are going way less often. There's a shortage of 19% on the offers. The result is the marketing time. The time it takes 3 out of 4 sellers to sell is 27% longer. Price reductions, this is huge, is 2.5 times bigger than they normally are. But keep in mind that 2.5 times is only a 1% reduction off the typical asking price on average. And part of that is because the vast majority of the sellers do their homework, price their home correctly, come on the marketplace and sell without any price reduction. But despite all that good news for the buyer, on good news for the seller, right now buyers are overbidding the seller's ask price by 7.7%. And that's more overbidding than they normally do, which is 7%. And lastly, prices are doing what they normally do at this time of the year, which is leveling off and going into a slightly decreasing mode. Not a bad time, no crashing of the marketplace yet, but also not an absolute frenzy like Silicon Valley normally is. This is how you participate. If you want the handout, you hit the QR code on the top left, type in the green root URL plus the letter H for handout, 2026 for the year, 0502 for the month and day of the presentation, or you type in the longer blue URL and it'll take you right there. That's a Google Drive URL. For the live presentation Saturday morning at 9 o'clock, hit the QR code or the green root URL plus the year 2026 or the blue Zoom link. To hit the archive on YouTube, type in the blue YouTube URL or the short green root URL or the QR code. I'm Richard Calhoun, working with buyers or sellers here in Silicon Valley and single agency relationships. Now we're going to start getting into a little bit more detail. This detail is showing the number of offers. This is for 1 week of offers, 2 weeks, 3 weeks, 4 weeks. The data is based on 5 weeks, so you have that. This is my early warning sign. And basically, it's showing no problem whatsoever. Yes, we're missing the median of the past 10 years is the dotted line, and the solid line is the current data. So in all 4 weeks, your current level of offers is below where you'd expect it to be. Remember, we're missing 19% of the offers. But based on the last 4 years, all the way back to 2022, the volume of sales is higher than it really has been. And it's the vertical black line is this week, 1, 2, 3, and 4 years ago. What you're looking at is this repeat of what we've seen for the last 4 years. Turnover time is the dark blue line or the purple line up here. You can see that you're having a slower turnover time. Right now it's at 38%. Yes, it was higher last year about this time, but we also may be going up. When you compare to normal, there's no way to predict which way it's going. Turnover time would be getting longer and we're just raw count, but I don't know if it's going to get longer than normal or longer, but less longer than normal. The next slide is the offers accepted, the orange line. And if it was a normal line for all 3 lines, you'd be right here on the black line right at 100%. So you can see that you're missing that 20%, that 19% of the offers accepted. Moving on to the gray line, which is active inventory, you can see you have a surplus of 24%. You have more selection to pick from if you're a buyer. Here's the individual metrics, and this is going back for the current quarter, the past quarter, and the future quarter. Obviously, I don't have data into the future, but it gives you an indication of which way the market's going. For example, in the first turnover time, you're 38% longer than normal, which is a slower marketplace. You're at 43 days, which is only 6 weeks that we talked about. But you'd expect that to be roughly flat for the next 4 weeks. Go from 3 to 4 weeks, you might start saying there's a slight uptrend, but after 4 weeks, there's definitely a slight tendency for longer and longer time frames. But right now, you're sort of in this flat period of time. A quarter ago, you were at 15% longer than normal, but it was a long, so that's better compared to normal. But the actual time was 51 days, and now the time's improved to 43. So the turnover rate is faster now than it was a quarter ago, but that's actually a worsening of the marketplace when you compare it to what the market normally does. Turnover time is a theoretical number. It's how long it would take to sell the existing homes at the existing rate of sales with no new inventory, so it's not going to ever happen. Marketing time is actually a real number. It only includes the successful sellers. The first one, turnover time, includes unsuccessful sellers when they're active inventory, and therefore is a little bit more pessimistic or maybe a little bit more realistic, where marketing time does not include the sellers that give up on the marketplace without selling because they never had a time on the marketplace that, they never had the offer accepted to terminate that time on the marketplace. Only successful sellers are included here, and you can see that it is significantly faster at 21 days. But that is 27% slower than it normally is. But in this case, a quarter ago, you were at 28 days, so you were again slower by a full week, but that was faster compared to normal. A quarter ago was 90%, so it was actually 10% faster than normal. Even though the time's improved by a full week, you can see the improvement right through here. It's now 27% slower than it typically is, or longer than it normally is. Price reductions, this is where the 2.5 times comes in. You can see your 2.5 times, you're only 1.25 times back here. So you've doubled the percentage of price reductions, but you've only gone up by 0.2% change from here to here. But that's been a doubling because normally price reductions go down. So at a time when price reductions are normally going down, they've actually increased, if that makes any sense. Overbidding by the buyer, this is what the pressure the buyers are feeling. Right now, they're overbidding 7.7%. Normally, they're only overbidding 7%. They're feeling more pressure than they need and a greater more pressure than they need than back here. Although even if you did it on a percentage basis, because 10% of 3 is 0.3, which is more, the differential here is less than 10%. Here it's exactly 10% of the lower number. Overbidding is still aggressive. It's more aggressive than it typically is, but it's not as aggressive as it is in a hot marketplace. So you're clearly not in a hot marketplace here in Silicon Valley. Offers accepted, 81%. That's 19% of the marketplace is missing right at the moment. And that's a deterioration from the 86% we were a quarter ago, even though the volume is more than doubled. It's gone from 1,000 offers to 2,300 offers. So a little bit more than doubling the number of offers. But on a percentage basis, you went down from 86% of what you'd expect to only 81% of what you'd expect. You can see the numbers are real close together down here. Now they've opened up a little bit and increased. Inventory, again, same sort of story. Your inventory is almost double, going from 1,500 to 2,800 at a time when the percent of normal has only gone from 106 to 124%. So an increase of only 18% of normal at a time when the market's basically doubled in volume is the number of listings available. And lastly, it's not almost worth talking about, but it's the number of transactions that close. And you can see that the 18% of the marketplace is missing. We're now closing 2,100 homes versus a quarter ago where it was only 1,000 because of the end of the year holidays, et cetera. But that was from 69%. So we're doing better on a percentage basis and on a raw count basis on the number of transactions that are closing. Here's a summary, a little more detail. You can pick it, whatever metric you want across the top. The bright yellow are sort of your leading indicators. The frequency of price reductions is probably the least valuable one. And the reason for that is sellers try to do their homework in Silicon Valley and try to take into consideration the current market conditions. The frequency of price reductions only goes up when the market is changing and the sellers haven't been able to take into consideration that changing marketplace into their analysis. Overbidding is a lagging indicator because you need the sold price. Here, this group of dark green up here are 6 indicators. To me, is really the key. Silicon Valley is slower than it typically is based on all the blue lines, especially here on the turnover time, much longer turnover time than normal. But your blue, which favors the buyer, or green, which is in sort of a balanced marketplace, their number of red is pretty limited, and that would favor the seller. But you can see there's very few isolated red indicators favoring the seller. Then offers and active inventory are light green because we don't have a raw count, because each micro market area is a different size. So the only thing we have is the comparison to the 10-year median. And you can see that you are around 80% for Santa Clara County, around 100% for San Mateo County, and around 76% for Alameda County. Active inventory, Alameda County is at 100%. San Mateo County is around 25% surplus of inventory, and the Santa Clara is at about 35% more inventory than normal. And I was reading the county levels overall. Appreciation, this is since the last 9 months of 2015, simply which areas have had the highest appreciation. I do need to point out that Santa Clara County has the highest at 119%, but anyone that pays attention to data will say, how can you have a county go up 119% when the largest individual area has only gone up 8%? It's quite simple. The more expensive areas, which would be basically Cupertino, Sunnyvale, Saratoga, Los Gatos, and Los Altos and Palo Alto, are selling better than the affordable areas. And therefore, just because they're making up a bigger market share, the price for the county is increasing, even though the price of each micro market area is not increasing. So if you did a weighted average of the appreciation rate, it might be somewhere around 90% or 95%, somewhere in that range, nowhere close to 118%. And that's one of the reasons why Santa Clara sticks out so much. Price range, instead of following just the median number, which is the middle number here, I sandwich it by adding in the 90 percentile, the most expensive range of a home that you'd expect to see, the least expensive home you'd expect to see, as well as the right-hand number, which is the most expensive home you see. So 80% of the homes in any given micro market area sell between the two extreme outside numbers. 40% of that 40% sell between the left-hand number in the middle, and 40% sell between the middle and the right-hand number. Here's some definitions of what we're going to be going over into next. Here is the first micro market map. You can see these are the range. So it's 7 days, it's saturated red. 7 days, 6 days, 5 days are all the same color of red. But from 7 days to 42 days, you have a graduated turn of red. Once you cross over in 42 days, you're some shade of green, and that could be a yellow green to a blue green, depending on which side of normal you're at. And then finally, you have the blue color, which starts at 78 and goes up to 145. And it is a step function, because with the map color, I needed to be able to see the color on the map versus just the map background. Because if you did two areas between the hot and the balanced marketplace, and between the balanced and the neutral marketplace, you'd have no idea which of those two white areas it was. And so by doing a step function, you can actually see the increase. So it's not a nice, smooth integrated coloring scheme, but it's the best one I can come up with without coming up with something a little more complicated, which I'm still thinking of. Now moving on to turnover time versus the 10-year median. You can see Santa Clara County clearly has a longer turnover time versus normal. And looking at it, you might think that Alameda County is a little bit red in color, but that's actually blue in color. You can see the colors over here better where you have a white background. You can see it's 25% longer turnover time than normal. And the only area that's doing normal is San Mateo County, and it's on both sides. You got some areas like Redwood City at 87%, that's faster than normal. Areas like Atherton and San Mateo County Coast that are right at normal, or even Belmont. And then things like Pacifica, which are, clearly slower than normal, or areas like Foster City, the deep blue up here, that is way slower than normal, but it's a small market area, so it doesn't make a whole lot of difference. Here now is marketing time, just the time for 3 out of 4 sellers to sell. And this is raw count. So you're going to be a shade of pink from 1 to 3 weeks. You're going to be green from 3 to 6 weeks, and 6 to 12 weeks, you're going to be blue in color. You can see that most of the areas are red in color. So we're selling most of the valley in 21 days or less. And you can see they're all very closely grouped together. There's no real outlying areas. The longest outlying area I'm seeing right now is Saratoga, Los Gatos, and South County. And they typically, ever since I really started paying attention to this back in '96, those two micro market areas have always had longer marketing times than Silicon Valley as a whole. Here's marketing time versus typical. So now you're doing the comparison, and you can see that you're clearly green in color. So blue to green in color, so longer marketing times. And you can see that with 127 for Silicon Valley, 135% for Santa Clara County, 115% for San Mateo, and 26% longer for Alameda. So Santa Clara County has got the race to last place on turnover time compared to normal. So Santa Clara County is the slowest compared to normal of the three counties. Here's price reductions from the seller's ask price. This is just an average, so this is just how much your seller's doing, and it's a raw count. If you look at the map, it's mostly green, so it's anywhere from a 0.25% reduction to a full percent reduction. You can see Santa Clara County is right at that 1%, just over. San Mateo County is around 0.7%, and Alameda County is just shy of 1% price reduction. Here's versus typical. So you can see that green and blue is the color for Santa Clara County. San Mateo County is mostly green and blue, but there's also, well, it's all got all three colors from slightly more than normal to slightly less than normal amount of price reductions. And the same with Alameda County, but Alameda County only has more price reductions. Here's the frequency. So now this is how common are they? So even though the price reductions happen and they're happening a little bit larger magnitude, they're really not that common. You can see that you're renting with less than 17% of the sellers are doing a price reduction. So I'm not seeing any areas where you've exceeded about 25% of the sellers doing a price reduction. In fact, there's only one area that's even close to that high, and that's South County at 23. From there, it looks like I might be going down to 19%. Yeah, so the second place finisher is 18.7% of the sellers doing a price reduction in Milpitas, Berryessa, Blossom Valley, and Santa Teresa. This is the frequency of those price reductions. So how common is it compared to normal? Milpitas, it's 3 times more common than it normally is. So way more common, but going back to here, it's only less than 1 in 5 sellers are doing a price adjustment, but that's 3 times. So that means you normally have something like 1 in 15 sellers were doing a price reduction in normal times. You have to keep balancing back and forth because there's an expectation that's built into people that have been around the business for a long time here in Silicon Valley. And frankly, we're spoiled with how aggressive the marketplace is, even in times like now. And even in 2022, even though the prices dropped more, as long as you had a seller that was willing to drop the price to where the market dropped to, you still sold quickly. It was the sellers that were resisting the price drop, because that was the biggest and fastest price drop I've ever seen in my career. You're looking at it, your frequency compared to normal, it's basically favoring the buyers, especially in Alameda County at 25%, 29% in Santa Clara County, and 5% more in Santa Clara. But it varies in Cupertino, it's actually 60%. So you go from half of what it normally is to 3 times what it is in just 2 different micromarket areas within the same county. And that's one of the reasons I'm a big fan of micromarket data, is no one micromarket area is performing like the county, or the county data doesn't indicate what any given micromarket area is doing. Here's overbidding on average. So the average overbidding, it varies quite a bit from 11% in Alameda County. So that's where the most overbidding is happening. And the very most overbidding is happening on the island of Alameda and the city of Berkeley, followed by Oakland, believe it or not, with a lot of overbidding. And these two have been leading the pack forever now. After that, you jump down to, I think, 9% here, I'll call it 10% in Cupertino. And then you jump down to 8%, I think. After that, actually, you got 11% and 12%. And they come in pretty quickly after that. Buyers are willing to overbid the seller's ask price to get the house they really want. And some sellers price their home low to entice those multiple offers. Overbidding versus typical, you can see in Santa Clara County, less overbidding than normal. Alameda County is actually a little bit more than normal. It's sort of interesting. You're at 3% more overbidding than you typically do, but the only areas that are above are Oakland and Berkeley and Alameda, 5%. Most of it's right around 100%. Overall, overbidding is just about normal, and it's a little bit on the cool side in Santa Clara County because of the moderate priced areas where we're missing basically 2.2% of the overbidding that we'd expect to have. Here's the frequency of overbidding. So how common is overbidding? Real common. I mean, everybody's in the red. I'm not seeing any blue, though I see one green, but the red is basically 50% to 95%. So more than half the sellers in Silicon Valley are getting more than their asking price. So the two areas that have green are the South County area of Santa Clara County, where it's at 44%, and then the area of San Mateo County Coast at 36%. Both pretty close together. San Mateo County is actually turning a blue-green, it looks like, where South County is a pure green. Frequency of overbidding compared to typical, you can see that you're less than normal. You're right around 92%. The only area that really stands out is Alameda County with way overbidding. It's got a range of 76% in Newark and Union City to 106% in Berkeley and the Alameda. Here is the offers accepted based on the 10-year. You can see it's basically blue in color, so there's a lack of offers. The area that's doing the best is San Mateo County, where it's actually 2% more offers accepted based on the past 10 years. Now, they might be being helped out by the years right after the pandemic being slow compared to Santa Clara and Alameda County. Here's the active inventory. So you can see that Santa Clara County's got the surplus. Alameda County is about normal, but right at 10% more than normal. That's a little bit of a blue-green. And then at San Mateo County is sort of mixed up a little bit, where you go from 211% on the Pacific, and that actually doesn't look like it's that blue, but Pacific is up here is the fainter blue, and then Half Moon Bay down here. And if anyone knows a map like Google Maps that has a white background, that would make it easier to see these colors, because I'm fighting the background color of Google. Appreciation, you can see the areas that are hottest, basically the more affordable areas that were close to work. The San Mateo area that did the least well overall. And then in Pleasanton, it was on fire after the pandemic, but once people started to have to going back to work, it seems that people are not willing to tolerate the longer commute. Here's the prices. They got the median in the middle, the lowest 10 percentile on the left, highest 10 percentile on the right. So between the two outer numbers, you have 80% of the homes, 40% between 900,000 and 1.7 million, and 40% of the homes between 1.7 million and 3.9 million. Gives you an idea of what your price range is in each area. Here's the summary chart that we already went over. And we hit this already, Silicon Valley real estate market. You can get to each one of the things, whether it be the handout, the Zoom meeting, or the YouTube channel. Again, I'm Richard Calhoun, Creekside Realty, working with buyers or sellers here in Silicon Valley in single agency relations. And let's move on. This is some customization work that I do. Some definitions of the upcoming slides. Here now we're looking at the Silicon Valley, all three counties, Santa Clara, San Mateo, and Alameda County in a blender, compared to the median, which is the gray line. The blue line is either the 10 or 90 percentile. It's the percentile that favors the buyer. So in turnover time, it would be the 90th percentile, the long turnover time. On offers, it would be the low number of offers that would favor the buyer. And the red color is the side that always favors the seller. And again, it's either 90 percentile or in this case, the 10 percentile. So you're clearly slower than normal. And this is turnover time. This is the time it takes to theoretically sell the marketplace out once. Here's a percentage of normal. So you can see you're at that 38%, I think it was, of normal. So almost 40%. So it's clearly slower than it typically is. You can see it's been climbing up fairly steadily this year. Here's the marketing time. This now only counts successful sellers, because if you don't get an offer accepted, you have no time period to get that offer in the door. And that's how I measure marketing time. It's not the time you're on the marketplace, but it's the time it takes to get your offer in the door. And if you never get the offer in the door, it doesn't count. And that's one of the reasons this number is so low at 21 days. But not that many sellers in Silicon Valley come on the marketplace and then never sell. They give up permanently without selling. They may relist, but then that's still an active listing. And as long as they're not off the market for 30 days, I should be able to catch them and not reset them as some people try to do. Here's marketing time on a percentage of normal. You can see we're slowing down. We're about 28%. So 28% slower than typical. This is the slide I like. It's showing what the sellers that are taking the highest price reductions, what are they doing? And they're basically taking an 11.25% price reduction, which is not small numbers. In Silicon Valley, with the typical home being around $2 million, especially in San Mateo and Santa Clara County, Alameda is more affordable, about 1.3 million. This 11% turns into be a $250,000 price reduction. So these are not small numbers for the seller that's doing that. Here's the average. You can see when you average it out, it becomes a much smaller number, about 0.9%. And that's because the vast majority of the sellers are doing no price reduction. But it's showing you that It started coming down earlier this year than it typically does, because typically it waits till the end of first quarter before it reduces. Here it started reducing halfway through first quarter, and it's continuing its climb down. Here is the reduction versus average price reduction on a percentage basis. And you can see that you're below the gray line, favoring the blue side. If you were normal, you'd be right on the gray line. If you're in the middle box, you're somewhat in normal marketplace. Down here, you're clearly favoring the buyer. And that's been the case not very often, really, by this magnitude. And this is comparing the raw count now to the raw count typically at this time of the year. And the big reason is we are taking price reductions this year, where at this time, normally we are not taking price reductions. Frequency of price reductions, so how common are they? You can see right now only about 13% of the sellers are doing price reductions. So that's somewhere around 1 in 7, 1 in 8 of the sellers are doing a price reduction. Here's a frequency on normal, so it's 20% more sellers are doing a price reduction. That's not insignificant, but it's also not as much as we've been up here. We've had double the number of sellers doing price reductions at different times. Overbidding, how common? This is the median number. So this is half the buyers come in and overbid by greater than, what would it be, 4.5%, and half come in and overbid less than 4.5%. So the median is the midpoint, half above, half below, and that number is 4.5. Everything else on average. And what is the average overbid? Right now it's 7.7%, which is 0.7% above the typical. The typical would be right here at 0.7%. You're 0.07% above that, so you're at 7.7%. You're 7.7% versus 7% above the seller's ask price. Here's the frequency of overbidding. So you can see that normally you have more overbidding going on, but you're still right at 70%. So 7 out of 10 are doing a price reduction. So that's still fairly commonly priced. It's at some of the highest levels we've been. Yes, you've been at higher levels since 2022, but they've been short-lived. Here's the frequency for Silicon Valley compared to normal. So you're only at about 95% of the frequency overbid that you would expect it to be. Fewer sellers are overbidding compared to normal. Here's offers accepted. You should be way up here on the gray line, which is somewhere around 2,900 transactions, or almost 2,900. Instead, we're down here around 2,300. But again, you're favoring the buyer by having less offers accepted, and you're missing a marketplace. But if you look back, you can see that market's been missing ever since the end of first quarter of 2022. Here's the active inventory. You can see that you're right up on the blue line, so you have more inventory than you typically do. And here's the appreciation. Here's what I looked at. I looked at the cheapest 10 percentile, what it was doing, as well as the median in the orange and the gray. And you can see the 50 and 90 percentile are mirroring each other right now. You can see they were separated back here, and the 10 percentile and the median were agreeing back here. Now the 10 percentile is the low man out. The ebbs and flows do happen. Right now, the higher end prices are doing better than the lower end prices. Here's another price model that would show that. I'm looking at the prices and what's happening to the top 10% of the marketplace. There's been in a slight climb ever since the peak of the marketplace, and they're above their previous peak. They're above this 2022 peak. If you look at the median is basically right at its 2022 peak. And if you come down to the low end, although the prices are flat, it's currently below their 2022 price. So all three have some unique features. This one is the high expensive homes. The unique features, the homes appear to be appreciating right now. The takeaway here is you're close to your 2022 peak pricing, and you're flat with maybe a small hint of up. And here you're definitely below your 2022 price peak. Here's the monthly payments, and I'm using the high balance conforming loan limit interest rate, which is a little misleading because most people in Silicon Valley would be doing a jumbo loan, which is going to be at a different interest rate. But I've not been able to find a long-term source for jumbo money, and jumbo money does flop around more than conforming, where sometimes jumbo money is less expensive than conforming, and other times it's more expensive. And by conforming, that includes high balance conforming. Here's some more definitions as we compare the three counties to each other. Here's the first slide of the turnover time. You can see San Mateo County is by far the fastest turnover time at somewhere around 35 days. Santa Clara and Alameda County is very close together. And look at this huge increase, slowdown in Silicon Valley. Here's the time to sell. This is at 3 out of 4 sellers. Again, San Mateo County is coming out on top with about 19 days. And Santa Clara and Alameda County are right next to each other at around 112 days. Here's ask price reductions. You can see that Santa Clara County is doing the most price reductions at just over 1%. Alameda County is next at just under 1%. And the area doing the least amount of price reductions on average is San Mateo County. Here's the frequency of price reductions. Santa Clara County, again, has the most price reductions. But again, keep in mind, it's less than 15%, so less than 1 in 7 sellers are doing price reductions. And then you have Alameda County and San Mateo County essentially tied at 11.5% of the overbids. Here you're seeing the overbid average, and you can see that it's rolled over, so it's coming down. And this is a lagging indicator. The peak was basically right at the end of first quarter, which is basically April 1st, but the peak of that marketplace is actually 5 weeks earlier than that. So the peak overbid probably happened somewhere around February 21st of this year. Often the peak marketplace as far as overbidding and stuff is right around Valentine's Day. Frequency of overbidding, you can see they're all coming down. Right now, Alameda County might be argued as flat, which is doing the best at 71% of the sellers getting more than their asking price. Santa Clara and San Mateo are very close together. Santa Clara is 68% of the sellers getting overbid, and San Mateo County is at 66% of the sellers being overbid. This is simply the number of offers accepted. You can see Santa Clara County has the most offers accepted, about 950. Then Alameda County next at about 850. And in third place is San Mateo, but they're handicapped because they're the smallest county, is at about 475. Here's active inventory. Santa Clara County is at the most inventory, just over 1,200. Alameda, again, is second place. You can see historically they're very similar. The fact that there's a separation is significant. And like last year, Santa Clara had less inventory than Alameda County. This year, it's having more inventory. And again, San Mateo is in last place, but that's because of its size. Here's appreciation. Santa Clara has the most appreciation, but I pointed out before that's because market mix. San Mateo County is second, and Alameda County has the least. But even at 80% appreciation for 11 years, when you're leveraged out, typically when you buy a house, is a pretty good rate of return on your investment. Here's the median sold price. You can see San Mateo is on the top, followed by Santa Clara and Alameda. Here's the same information on regular paper. So you can see San Mateo is at 2,200, Santa Clara is at 2,100, and Alameda County is at 1.3. You can see Alameda County is clearly below its peaks of each of the years. Santa Clara County is very close to its peaks and above its peaks in all except for last year, and we're not quite yet to the peak of this year. You can see we might come up and may go up a little bit more next week, or we may come down. It's hard to tell. And San Mateo County is basically at its peak level. So even though prices have been flat, we're within each year, you have this cycle back and forth, and all three counties are roughly at their peak, except for Alameda County, which is clearly below its peak. Here's the PITI payment, going through an 80% loan at the high balance rate, and then putting an estimate for property tax and insurance. Here's the sales volume only. The big, you got to pay attention because the pandemic over here impacts the data. Because remember, we couldn't show properties in 2020, and we've already turned around because starting on May 1st, you can show property that was. You can see that 2,300 is up from where we were last year. But if you come up just a few weeks ago, you can see we were doing a lot worse. So right now, volume of sales are doing okay as far as the past 10 years. Here's each county, Santa Clara, San Mateo, and Alameda counties, the raw numbers, as well as Silicon Valley overall. The reason I have the May 3rd again is May 3rd is my normal comparison date. These numbers are getting compared to May 3rd. They're close enough on Saturday because very little activity gets reported on Saturday. Whole lot of showings happen in open houses, but that activity gets reported later in the upcoming week. Here's some distributions. We have 3 distributions: marketing time, reductions, and overbid that we'll get into. Here is the marketing time. We're going to start off. Notice how close together the purple line is on top of the dotted line. It's almost an exact copy of it where we were a year ago. See, right now you're already slowing down, so you're having longer and longer marketing times. That's what I would expect this year to do. Basically, I expect the current year to repeat the previous year unless there was some anomaly. Now you can see you're still climbing. That's the beginning of August. Now you're doing an improvement, plateau actually, because that really hasn't changed. Now you have the improvement at the end of September, And now you're going to go the other direction at the end of October and start slowing down. And you're going to slow down all the way until probably January the 3rd, right there. That's the slowest for the year. Then you're going to improve. Notice how steep the line's getting over here. See how steep that is? Now it's already flattened out. Now you know the market's already deteriorating and slowing down as that flattens out. And now you're just going to march up from now until sometime in the fall, and you may or may not have that correction that we saw last year where you had the little second spring flurry in the fall. Same concept with price reductions. It is a little interesting that the curve here is up like this versus down like that last year. I don't know how much of that is just my data acquisition, because I don't have that many data points, and it could be just the way Microsoft is calculating the best slope through the different data points. Because I have a data point, I think, at every 2.5%. So I have a data point here, here, and here. So you have one data point that would be completely different. And I'd have to verify that. I think I have one data point for each line. So they have one data point here that was significantly different between the 2 years. Other than that, it was very similar. Anyway, you can see that you're stepping down and you're immediately cooling off. So you're taking larger and larger price reductions as you move towards the record blue down here, which is the worst we have. So it's favoring the buyers more and more. There's about the bottom. It's the plateau. A little bit of improvement, another plateau. Now you're going to come up to moving right there. Another improvement, maybe one more. Nope, already deterioration. So on the 25th, you're already going down the other way on October. And now you're cooling off for the end of the year. And now earlier, at least by January the 3rd, it's reversed and accelerated up very quickly. So the big takeaways are, in the short term, you'd expect larger and larger price reductions going forward. And now you're finishing off with a couple more weeks. I think next one is this week. Yep, there's this week. So you can see from here, you'd expect more price reductions. So you're going to start getting 17% of the sellers doing a price reduction. And right now you're only at about 15%, 14% of the sellers are doing a price reduction. Here's the overbidding, same concept. Look at the gray line, the purple line and the dotted line are better behaved. Little separation with more overbidding this year. I would almost suspect, and I don't have the data for doing this, so it would be hard to do, as I almost suspect that more sellers are pricing their home low, creating this artificial high-end price reduction, because this is 5% of the marketplace. If you go here, it's somewhere around 11% of the sellers are doing something different that's giving them a higher overbid, where 90% of the marketplace is getting exactly the same overbidding as we did last year. And, based on a little bit of sluggishness, I can see there's the pressure. The fear of missing out is really important in this industry. And if you can trigger that, you usually get a higher price for the sellers. With the uncertainty of the marketplace, if listing agents are getting their sellers to price lower, that's exactly what you'd expect. That 10% that's now pricing lower is getting a higher overbid. This is a measure of the buyer competitiveness. That's the amount of overbidding. Let's step through. You can see that it's basically still flat for a couple now, right there. So on the 24th of May, you'd expect it to go down. So I would expect it flat for a couple more weeks before it turns around and goes down. But then and after that, it's the same pattern, but it's delayed from my other metrics because of the lag time. There's that improvement at the end of the fall, and it's a longer improvement period for price overbidding. And now it's going down for the end of the year. But look at where the peak is. The bottom isn't there on January the 3rd or the 17th. It's right there on the 31st of January. Now it's starting to improve. 4 weeks later in January, when people are already doing quick closes. And there's sort of the peak right around April 5th, April the 12th. You could argue on which one it is, but if it's April the 5th, you subtract off 5 weeks from that, and you're right back to the end of February. And here we are right now. Most likely, since there's a 3 to 6 week lag in the sale price, and I'm saying we're only got 2 more weeks for the overbidding start going down. Overbidding has probably already gone down in the offers that are being negotiated for the last couple of weeks. Now you're leaving the Silicon Valley, including the name, and now including the Greater Bay Area, which is 13 counties and 5 regions. These are the 5 regions on the left and numbered, and the counties that make up each one of the regions. So a little bit of definitions and the slide numbers that it's referring to. So here, what you're looking for, mostly in my opinion, is the turnover time. Is it going up or down? And is it going up or down differently in the different areas? The purple is down here is Silicon Valley, and it's clearly climbing. The other 4 regions look like they're going down, still improving. The turnover time is only really deteriorating in Silicon Valley and still improving in the other 4 regions. So whatever's happening is happening in Silicon Valley and not globally. Here's the time to sell, climbing in both the purple, Silicon Valley, and the cities, starting to look like it's going to climb in Central Valley, looking like it might be starting to climb in the Central Coast, and clearly still flat in the North Bay. Again, clearly what's happening in the Silicon Valley and in the cities is a little bit different than what's happening in the other regions. In general, I would probably could buy into all the marketing times are getting longer. Price reduction, again, Silicon Valley is leading the way with the amount and duration of the price reductions. The cities is probably next. But now notice all 3 of the other regions, Central Valley, North Bay, and Central Coast, have all rolled over. So everybody's rolled over and taking greater price reductions already this year. Frequency of those price reductions, again, what's happening? Silicon Valley and cities are both increasing, but look at the Central Coast up here in the light blue and also the North Bay. The only one that doesn't look like it's changing yet is the Central Valley, the frequency of price reductions. So even though the magnitude of price reductions was starting to look like it was increasing in Central Valley on the previous slide right here, see how it's rolled over and coming down? So you're starting to take greater price reductions. The frequency of that hasn't rolled over. So that means the sellers that are taking price reductions are taking larger price reductions, but the number of sellers has not yet started to increase in the Central Valley. Here's overbidding. Silicon Valley is rolled over. You could say that the North Bay is rolled over. Nobody else has. Look at the cities. The cities is going through the roof. Central Valley is still climbing. Central Coast is still climbing. And the North Bay, I would say, is still climbing with just some statistical fluctuation. So again, Silicon Valley is behaving differently on the average overbidding, already decreasing this year. Frequency of that overbidding clearly rolled over in Silicon Valley, might be flat in the cities, could be flat in North Bay, could be flat in Central Valley, and could be flattening out in the Central Coast. But again, it's clearly rolled over in Silicon Valley. So it appears that Silicon Valley is winning the race towards a less favorable marketplace for the seller. Offers accepted, all offers accepted are still increasing in all regions. There's a little hiccup up here in Central Valley, but you can see there's hiccups all the time that are short-lived. I would say all 5 regions are increasing number of offers. Inventory is increasing in all 5 regions, which is, some similarities. And then appreciation, it's harder to tell. Silicon Valley has the highest appreciation, but we've already talked about the market mix really impacting Silicon Valley. Then you have worse depreciation being the cities in the North Bay, and the Central Coast and the Central Valley are sort of in between. Not sure I can really make any heads or tails out of that. And here we have the Greater Bay Area pricing for the 5 regions. The most expensive is the cities, and it's rolled over at least for this last week. So it's sort of there. It's below its 2022 peak. Silicon Valley is right at its 2022 peak. Central Coast is right at its 2022 peak. North Bay is below its 2022 peak, and Central Valley is below its 2022 peak. You got a couple of areas, the more expensive areas are right at their peak. The cheaper areas are still below their peaks. Again, the theme here is the more expensive homes appear to be doing slightly better than the lower priced homes. Here's the estimated monthly payments in the same order as the price because they all go through the same formula. Again, I'm using an 80% loan high balance and an estimate for property taxes and insurance. Here's the numbers. So you have the now column. The now column over here is the one with the current value. This is the value change from 1 week ago, the value change from 5 weeks ago. You can read across the metric as well as the region down the side. In addition to I have all 13 counties in the 5 regions. The regions are in bold and they're separated so you can see. I've also added in the Bay Area, and that's because the media covers the media reports on Bay Area pricing. I believe it's a total garbage number. I don't even think the county tells you what's happening within the different micro market areas, and real estate's local. So what's happening in one micro market area is not the same as it's happening in another micro market area. So I think it's important to look at micro market data. And with that, this is my weekly data. I start basically on March the 1st. The yellow lines are leap years, so you go back one less day because you have February 29th in the yellow, and you get your 52 weeks. Then you work backwards and you come up with January 3rd being the start of the year. The discontinuity is right here on February 21st. I jump forward 8 days on a regular year. I jump forward 9 days on a leap year to get back to the March 1st. That way I only have one discontinuity and I'm comparing the same dates to the same dates year after year. I think that gives me the best stability in the unstable real estate statistical industry. With that, we've been talking about the Silicon Valley real estate market. We finished up with the Greater Bay Area, 13 counties, 5 regions. I'm Richard Calhoun, real estate broker with Creekside Realty. If you want the handout, it's up to 78 pages. Hit the QR code or the tiny URL link here in green, plus the letter H, 2026-0502 for today's date and month and year date. If you or type in the longer blue URL. This is actually the link of this morning. I upload the link and then update my slides that present you the current data. Join me Saturday morning, have a robust, almost anonymous discussion if you want about the real estate market conditions. That's what I was hoping would happen, but nobody's really taking me up on that. And then you can get there by typing in the green root URL plus the year 2026 or the blue Zoom link. You also can do the same on the YouTube channel archive or the tiny URL. Again, I'm Richard Calhoun, real estate broker with Creekside Realty. Have a great week. Take care. Bye for now.